So I learned some hard lessons those first few years as an entrepreneur. I went into it thinking I knew everything because I did have a great education. I did have a great corporate background and a fantastic financial foundation. But it was being an entrepreneur in that difficult economy was really, really challenging.
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is the Trinity of freedom: time, financial, and geography freedom. I'm your host, Missy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now I'm on a mission to help hundreds of thousands of people like me to do the same.
Awesome. Welcome to another episode of the American Dream Builder and Investor podcast. Today, we'll have another special guest and also friend, Tom Dunkel. So Tom and we've met in person as well last year. And right now he's been investing in the self-storage space, but he actually brings over 27 years of real estate, finance, and investing experience to his position as the Chief Investment Officer at the Belrose Storage Group. And working alongside of his world-class team of professionals, Tom actually makes it his mission to find great investment opportunities for his clients while helping them meet their wealth-building goals. Tom mostly focuses on arranging loans with local banks and talk with brokers in this process, and he also talks with investors as well. And Tom has, a great deal of not only just corporate experiences, but also entrepreneurship experiences as well. He actually currently lives in Wynn, Pennsylvania. He enjoys golfing, hiking, playing guitar. That one I didn't know until now. So he's definitely an avid investor and loves learning, which he'll also share a little more about his learning journey as well. He's actively involved in organizations like self-storage masterminds, Raise Masterminds, Mastermind we both are in, and also Lauren Claff Brand Trust. So without further ado, I'd like to welcome you, Tom, into the American Dream Builder Investor podcast. Is there anything in the bio that I missed you feel would be important to highlight to our audience?
No, thank you, Missy. I appreciate you having me on the show today. No, I think you just about covered it. I started out in corporate world, did a lot of things in entrepreneurship, and but I also like to have some fun with my family and my friends outside of work. So I think you covered all of it.
Yeah. And when I look at your experiences going from kind of the finance aspect with your educational background as well, finance economics went into like acquisition, financial planning in the corporate world. And then you start investing in the real estate space, whether that's in properties or later on, I think you also invest in notes, right?
That's right. Yeah. So I did start out in corporate America, and after I got out of business school, I was doing mergers and acquisitions and capital raising. I started out in the aerospace industry, which was a lot of fun. I worked with a lot of really fantastic people that came out of some top schools like the Wharton School of Business and Harvard, and worked with retired Air Force colonels and even some astronauts. So that was a lot of fun. But I always wanted to do something on my own, entrepreneurial speaking. So when I actually got fired from my corporate job in 2006, that was kind of, the wake up call to me, because I'd always felt like the corporate ladder wasn't really the way that I wanted to go. It wasn't going to get me where I wanted to end up. So I left corporate America in 2006. So my timing wasn't fantastic to go into real estate because, of course, we were right at the beginning of the Great Recession. So I learned some hard lessons those first few years as an entrepreneur. I went into it thinking I knew everything because I did have a great education. I did have a great corporate background and a fantastic financial foundation. But it was being an entrepreneur in that difficult economy was really, really challenging.
Yeah, I can imagine during that time. And, we're kind of starting to see some of that now with the deal flow is slowing down a lot more, but there's just some buying opportunities. So for the first part of the conversation, I wanted to drill on kind of your entrepreneurship journey, which, ties into investing. Talk us through kind of from an investing entrepreneurship side, what are the things you tried, whether it's business asset classes or operating models, what worked and what didn't work?
Sure. Yeah, that's a great question, Misi. I certainly have tried a lot of different things. When I first got into real estate, like a lot of people, I started out in residential. So I was doing some wholesaling and fixing and flipping and picked up some rental property and those kinds of things. But man, it was just really competitive. I was in the Philadelphia market and it's just very competitive. The market was moving against me and the rest of the folks out there. And so it got really, really difficult. Lost a lot of money is the real way to say it. But, that did force me to kind of look for the next opportunity because I was determined to stay in my entrepreneurial journey. I didn't want to, go back to the corporate world, nice warm blanket. So I started looking at other asset classes and that's when we found us mortgage debt. So we started buying pools of distressed mortgages in 2010. When I say I picked up a business partner back then named Joe Downs. And so we've been business partners now 13 years. And that business has done great. We've generated over $50 million of revenue in that business over time. It's still going. But along the way, we wanted to diversify and find some other things because distressed debt is great, but it's also very volatile. So it can go up and down significantly. So we wanted to find some other asset classes that would help us diversify and smooth things out. So we tried hard money lending. We went back and did some fixing and flipping of some houses. We tried multifamily, but we ultimately settled on self-storage. And it just checked all of the boxes for us that we were looking for. It's a fragmented industry, so very much like the distressed debt industry. There's players at all different levels. There are deals in distressed debt because it's sort of a quirky asset class. And if you don't understand it, a lot of people just pass by it, which creates buying opportunities for us. Self-storage also is very recession resistant over time. Over the past 40 years, in fact, the occupancy at self-storage facilities around the country has gently bounced between about 80 and 90% over that time. So that means it generates consistent income, which leads us to the next highlight, which is that self-storage facilities do not default on their loans. If you look at the different asset classes within commercial real estate, hotels default a lot, office buildings default a lot, and then it kind of goes down to like retail and multifamily, but self-storage doesn't even register on the scale there because it's such a high cash flowing, low operating expense asset class that it's very secure in that regard. And self-storage is becoming more and more utilized by more and more households across the country. So for all those reasons, we just really like self-storage and we're excited about being in the asset class.
Mhm. Yeah, that's definitely important to be diversified and look at opportunities as the cycle of the market changes. Some people take the approach that the market is too hot, so we can buy. The market is too bad, so we can buy. But it's really about shifting the lenses and looking at what you can do in those markets and how can you leverage your strength differently. So while I was listening to a story, I noticed that you were making small progress until you found a partner. And that's where it took your business and later on other businesses, self-storage, to the next level as well. And for our listeners who are maybe passive investors or passive and active investors and et cetera, or who wanting to get started, sometimes we want to do it on everything by themselves. But I've experienced that's definitely not true. Like my business growth has been dependent on partners. So it seems like yours is the same. So talk us through, how did you find and identify your partners and what made the partnership so successful so far?
Yeah, great question, Misi. Yeah, well, I was just very lucky to have a number of great people just come across my path over the years. But my partner, Joe Downs, we met at a real estate networking event. It was in 2009. So, I had just, gotten my butt kicked in the residential world for a few years. He came out of the commercial world, which also went through a tough time with the Great Recession. So we were both at this event, just kind of looking around, talking to people, trying to figure out what our next move was. And he and I just met in the crowd, just sort of randomly, and got to talking. And we just sort of hit it off. And it turned out that we just coincidentally lived around the corner from each other. So we decided like, hey, let's meet up in a couple weeks and just, kind of check in, see how each other's doing, with our reinvention, finding that next thing. And so as we got to talking, I think ultimately it came down to values, similar core values. So neither of us ever wanted to go out and build some big behemoth corporation. We're both family guys with kids. We wanted to, be there with our families and enjoy, watching our kids grow up and that sort of thing. So we wanted to have that flexibility in our schedules, but we also wanted to make good money and kind of control our own destiny. So I think, and we were willing to work hard for sure, but when, work was over, we wanted to go and, spend time with the family. So it was kind of funny in our early years. There were many times when we had kids interrupting our phone calls or kids crying or, hey, I got to leave because, I got to get my kid off the bus or, take him to, baseball practice or whatever. So it was, we kind of had those similarities, those alignment on those key kind of values. So I think that's what's really allowed us to stay together. And, just like any other relationship, right? We've had our ups and downs, but with those core values in place, we've been able to then attract other people along the way with similar core values. And so we have a couple of key people have been with us. Rob's been with us, for 11 years now. Gretchen's been with us, I think, going on 10 years. So we have some people who have been with us a long time. And I think it is because of those core values that we have similarly.
I see. Yeah, I think alignment of core values is key, and sometimes luck does play a factor as well. It takes a while to meet the right people, whether in marriages, or friendships, or relationships and partnerships. And that's awesome. Thank you for sharing that. So, along your entrepreneurship journey, what do you think has helped your business to scale? You mentioned about $50 million in revenue throughout the years. What has helped you in scaling that, especially with mortgage notes? It's an area that you got some big players, but you also have, I think, a lot of smaller players as well.
Yeah. Well, full transparency, Misi, we have had some partnerships along the way that did not work out. So, I guess you got to take your chances when you can, as far as, connecting with the right people. Sometimes it just doesn't work out.
Let's talk about that a little bit more because,
Sure.
like what made it didn't work out and how did you discover that it's not working out? And at what point did you say, hey, this is not working, we need to cut it off? Because, the firing, some people hire too fast, some people fire too fast. So
That's right. Yeah. So, I guess along the way, we've had a couple different partnerships because, of course, when you're growing and scaling, sometimes you might not have the money or you might not have the skill set or, you're just looking for more people to kind of help out and maybe diversify your risk a little bit across more people. But so along the way, we partnered with some people, and when it doesn't work out, I think that's why it's important to have your arrangement documented, right? So we always had an operating agreement in place and we would set up a separate LLC, limited liability company. And just because even if things, seem great initially, there's always that chance that things could change in the future. And so you want that easy, eject exit button. And so we tried to construct our operating agreements so that we were able to do that. But we would enter into things initially thinking that we did have alignment and that we had those common core values. But I think the partnerships that maybe went sideways, I think we probably entered into them too quickly or out of, I hate to say it, but maybe out of a little bit of desperation or a little bit of, urgency on our side. Like, hey, we really, need to partner with those people because, maybe they had some money and they wanted to put it in a deal. And so, there's a number of reasons why, that might happen, but the partnerships that have been successful are, very, core values based. But even so, we do have operating agreements in place, a lot of discussion up front. In fact, we're in a I guess we're getting better because we're in discussions right now with a group that approached us about helping them build a self-storage facility out in Indiana. And so we're having some very open and frank discussions up front before we really, engage just about how we see things working out and whose role, where are the roles and responsibilities, and then the communication, how often are we meeting, just sort of those really important nitty gritty things. And then, so through those conversations, you're going to learn about what's important to those folks and what their core values are and how well they align with yours.
Yeah, no, that's important. The alignment of values and coming back to that, it takes some stress and bad scenarios sometimes to see the true characters of people. So sometimes only time will tell. So along your entrepreneurship journey to where you're at today, what makes you truly decide, oh, now it's time to look at a different asset class versus trying to excel in the asset class? I say that because, I also know some other self-storage operators. They started in multifamily, and I ask, why don't you do multifamily anymore? There's so many other people doing. They are saying that we
Right.
just would be super niche focused in one area. So sometimes as entrepreneurs, we'll have like a dilemma. Do you go start something new, or do you build something to be so big that has the potential to be so big?
Sure. Yeah. I had a similar experience actually, Misi. I started, I guess it was probably back in 2011, 2012. I did start out looking in multifamily and just found it to be super competitive. At that time, cap rates were already starting to compress. So I know that asset class pretty well, and I'm happy to say that I've been a passive investor in multifamily since 2013. So I've been in there for a while, but it is a difficult decision to make. But ultimately, that's what we as leaders have to do. We need to evaluate the information, and you never have all the information that you might want, right? And then you just have to pick a direction and go. So when we were having difficulty breaking into multifamily and looking at deals, and as a finance guy, right, I dig into the numbers, and I just couldn't see those deals penciling out and making sense. But when we started looking at self-storage back then, it did make sense. Those numbers still work. And so we were able to get educated. We were able to build a team around self-storage, and we just, picked that direction because we liked, as we talked about earlier, those different factors within self-storage that we thought made it a fantastic investment thesis. And we thought it was the best investment thesis that we saw out there at the time. So might we shift in the future? Sure. We're an entrepreneurial organization. First and foremost, we're investors. We're investing our own money as well. So we're looking for the best use of our own investment capital.
Yeah, understand. To be opportunistic is a key factor in keep up with the changing world for sure. Whether it's Amazon or Walmart, all the other companies, they're always looking at the next best investment for them to put their investable capital in. So, well, Tom, as you've been investing in the self-storage space since, I think, 2017, right? You said, or?
That's when we started looking at it. We got educated through like 2018, 2019. We joined a mastermind group and assembled the rest of our team. And then we didn't buy our first facility till 2020 until we were ready. We had all those pieces in place.
Mhm. Yeah, sounds like you're a man who like to, take the time to really understand the risks and the process involved. So sounds like you like to be prepared. So when it comes to running self-storage facilities versus mortgage notes, another area you seem to have developed a massive of expertise in, can you talk about how those asset classes compare against each other in terms of the returns, let's say at this time of the market, because every time of the market is different, and also the risks associated with them as well from your perspective, as we're entering into a potential recession or stagflation, or every economist has a different opinion what would be coming up.
This podcast is sponsored by Life Mission Capital, founded by me, Misi Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
Yeah. Yeah. Wow. That's a tough question, Misi, because they're very kind of apples and oranges a little bit, estate and self-storage. I mean, they're both real estate related. Ultimately, they both have a certain intrinsic value, right? Because of the collateral. In the case of notes, the collateral that's securing them. And in the case of real estate, or the case of self-storage, just the real estate that it's built on. But our business models are pretty different. So in distressed mortgage debt, we've grown our business to the point where we're buying directly from banks, right? So we're really buying well. And so that opened up a lot of opportunities for us. We can either hold on to the loans and we can collect them over time, or create modifications for our borrowers so that they can begin paying again. Or we have a downline of mortgage note buyers that we've developed over the years, and we can just turn around and sell loans at a nice markup, virtually risk-free. So that's a very different dynamic than self-storage, although with the potential recession coming up and real estate values kind of cooling off, that certainly impacts the value of our loans, because if the value of the underlying collateral decreases, then that's going to decrease the value of our loan. But just like in other asset classes, and including self-storage, it gives us optionality, right? And that's really what we like to see in any investment, is we like to see that there's multiple ways to make money, multiple ways to exit. So in distressed mortgage notes, we could either work out the loan, we can do a payment plan with the borrower, we could do a discounted payoff with the borrower, or we can sell the loan. And all of those are profitable exits for us. So self-storage as well, we look to have multiple exit opportunities when we're doing our value add strategies with our self-storage facilities. So for example, if we go into a facility, like we just acquired a facility last week, we're going to go in and we're going to implement our technology, the platforms. We're going to be pushing the rates. We're actually going to be doing an expansion there. So in about 2 or 3 years, we're going to have all of that done. We're going to have the new units leased up. And at that time, we're going to have some high class problems to figure out. So we're going to have to decide, well, do we sit on this asset for a while longer and make double-digit cash on cash returns? Or do we exit the facility on those returns into the next deal? So we like to have those multiple opportunities to make money. And in self-storage, one of the primary things we do is we acquire self-storage facilities that are just not being run well. People out there might not know this, but only about a third of the market is controlled by Public Storage, Extra Space, CubeSmart, Life Storage, those big companies that you've heard of, which leaves 2/3 of the market, or about 40,000 self-storage facilities around the country that are onesie, twosie, mom and pop owned facilities. And these are folks that, they're not going to the industry conferences. They're not in the mastermind groups. They're not using technology to its maximum potential. And so they leave a lot of inefficiencies in how they run their business. So we're able to go and acquire those facilities at a fair price, and then implement our value add strategies to increase the value of those facilities in a fairly short period of time, and then exit and hand over a nice return to our investors that hopefully they'll reinvest with us in the next deal.
Got it. So essentially, they both have very different, like you said, apples and oranges. And how about compared to multifamily? I know that one cool aspect of self-storage, apart from the fact that you don't really need to have much maintenance activities going on, at a high level, the overall expense ratio tend to be lower. In multifamily, depending on the asset class, it's common to see anywhere between 30 to 50% of your revenue to be expenses. How is that on the self-storage that and that's probably what makes it so profitable as well, right?
Yeah, that's spot on, me. See, there's a few key things that make, in my opinion, make self storage better than multifamily. And you touched on one. Our operating expense ratio across our portfolio is about 35%, which means $100 of rent comes in. We have spent $35 to cover taxes, insurance, maintenance, payroll, utilities, etc. So that leaves $65 to pay our debt and then also pay a nice dividend to our investors. In my experience, multifamily is about the opposite of that. So multifamily, $100 comes in and it costs $65 or $70 to cover taxes, insurance, maintenance, payroll, utilities, etc., which only leaves 35% to $35 to pay the debt service and hopefully leave something left over for the investors. Similarly, the capital expenditures, when we first acquire a facility, we usually earmark, depending on the size of the facility and the age of the facility, anywhere between $100,000 and $200,000 capital expenditures to clean up the facility, add some lighting, security cameras, fix the fence, fix the gate, upgrade this and that or the other thing, maybe do some painting. Um, but in multifamily, in my experience, those budgets are way bigger. It can be into the millions, where they're looking to really turn over a unit. They're looking to change out the Formica with granite. They're looking to upgrade the lighting packages, carpet, the paint, the windows and those kinds of things. We just don't have that in self-storage. I mean, we have metal boxes with concrete floors and roll-up doors. It's not a fancy, complicated asset class. And the last thing I'd point out is on the delinquency and the eviction side of things. When COVID came along, the government said, hey, no more evictions, right? They put the eviction moratorium over apartments. Well, that didn't happen in self-storage. In fact, in self-storage, we don't even have landlord-tenant law. We have lien laws. So on the 61st day of a tenant not paying, we're able to put that unit up for auction. And when whoever buys the contents of the unit through the auction, they have 72 hours to come in, clean out all the stuff and be on their way. So a lot of times, if even in a non-delinquency situation, we can have a unit emptied out in the morning. We broom sweep it. It's back up on our site to be rented. And a lot of times can be rented back up later that day or within that same week, which is a big advantage cash flow wise over multifamily.
Yeah, definitely. That is a big advantage, especially considering that it's less overhead and less headaches overall from a legal standpoint as well.
Mhm.
The multifamily side, that what I've seen is actually usually between 35 to a little bit over 55, and so in rare circumstances it may get to 60% like expense ratio, but staying under 35% is definitely nice. I think in the self storage side, you also have access to different loan options. You guys can get SBA loans, right?
Yes, we can.
How do you guys usually structure the debts in your acquisitions?
Sure. Yeah. We found best execution with the small local banks or credit unions. They seem to be more flexible with their underwriting and with their terms. In fact, recently we had a bank, a small local lender to a facility we acquired. They offered us 80% loan to value on the loan. But just with our experience and just wanting to be conservative, we actually said, thanks, but no thanks. We'll stay at 75%. Our numbers still work really well at 75. So, knowing where we are in the real estate cycle right now, we didn't feel comfortable. We felt that was, over leveraging.
Yeah, because it all comes down to how confident are you getting those revenues, and in economic turmoil, so recessions, whatever you call it, if it's coming soon, you don't know how people's spending power is. The overall spending power goes down to necessities like housing and food. So I don't know where self storage income would fall exactly, unless it's stuff that they really care about, which I know RV storage and all that space is also going really well. So with the self storage, one thing I have heard, and I haven't dug into a lot of the analysis on self storage, but what I've heard is that some of the areas are really overbuilt with self storage. What's your acquisition strategy in terms of the locations?
Yeah, that's a great question. It's interesting. There are certain markets where everywhere you turn, there's self storage. But just like any other asset class, there are real estate is very local, right? It's very localized. So when we look at a self storage facility, the first thing we do, even before we dig too much into the facility itself, is we do look at the market. So similar to multifamily, we want to see a growing population, we want to see that infrastructure investments are being made around there, schools and highways and sidewalks and, new building, new big commercial buildings here and there, road expansions, et cetera. We're also looking for a decent amount of income. We don't want the income to be too high because in a very high income area, that means people can afford big houses and they don't need storage. And on the other end of the scale, if the income's too low, that means we might run into delinquency problems and that sort of thing. So we like to be kind of in that middle range. And we're also looking for low crime kind of areas, again, similar to multifamily. But we're looking at housing starts as well, because that's going to be a demand driver, right? So if we, like the facility we just acquired in Georgia, there's 2,500 new housing units going in within 5 miles. So we know that's going to be a nice demand driver for that facility. But there are plenty of deals that we've passed on because when we do our analysis, we see that there's tons of competition, right? And there's just isn't enough demand to take up all that supply. So we call that a supply index. And it varies a little bit by market, but generally speaking, about 6 square feet per person, 6 to 7 square feet per person is about equilibrium in a market. So if we do our analysis and we see that the supply index is maybe 3 feet or 4 feet, that's an indication that perhaps that market is undersupplied and could be an attractive area. Whereas if the supply index is 9, 10, 11, 12, it tells us that maybe that area is overbuilt and has too much storage, but it could be a red flag that requires some further investigation.
It's good that you touched on some of the specific metrics to go over because it's like multifamily, right? Like if it's a 2-bedroom, there's only so many people that can live in there. So understanding whether it's above or exceeding 6 to 7 square feet per person, that's a good metric to go by. What do you use for gathering those data? For multifamily site, a lot of times we use CoStar. Hotels, we use Star Reports. How about from a self-storage standpoint?
Sure. Yeah, there are two specialized databases. Well, there's more than that, but there's two specialized databases that we use. One is called Tract IQ, and a resource that can give us the 1, 3, and 5 mile radius around our facility. It'll tell us, the population trends, the housing starts, the commercial influencers there. That means like the road expansions and that sort of thing. And it also will calculate not only the current supply index, but the future projected supply index based on census data and also housing start data. So we like that. We like that resource. The other one that we use is called Store Track. And Store Track has some overlap with Tract IQ, which is fine because we like to see different resources corroborating each other. And if they don't, then we need to dig in and find out why. But Store Track does a better job at tracking at the facility level. So we can look at our competition in that market and we can see like their rate trends for the various unit sizes over the past 12 months. So we use that resource so we can see that, hopefully the rental rates have been increasing over the past 12 months. There are some other resources out there that we use sporadically. One is called Yardi Matrix, which I believe they also do research in the multifamily space. Mm-hmm. And then Radius is another one that also is better at more of the secondary and tertiary markets, whereas Yardi is better in the primary and secondary markets.
That's a lot of data points that you can gather. I love that. I have a data analytics background and I love underwriting and seeing the data behind things.
Right.
So it sounds like you're really deep in the water from a self-storage side, from acquisition to really understanding the data.
Sure.
But you aren't just doing that by yourself. You're doing that with a team. You build a team along with your partners and brought on other team members as well. Can you talk through what what has helped you build a successful team into an area that you started to gain traction? So, especially at the beginning, it's tough too, because you're trying to prove out your track record to investors and partners and vendors at times as well. So can you talk through the process of building a team, especially from the beginning?
Sure. Yeah. Well, it all starts with the vision. So as the leaders of the company, and myself and Joe and our third partner, Tim Kane, we set the vision for the company. And so once we set that out, what our goals are, what we're looking to accomplish over the next 3 and 5 years, then from there we can kind of back into using those core values, what the team needs to look like to get us there. And so as we're adding people to our organization, we're using our core values as a filter because we want to make sure that at a core values level that we're all compatible, right? So I think if you find a smart person, they can probably learn whatever it is, that we're doing. We're not splitting atoms here or shooting off rockets. I mean, what we're doing is pretty basic, but it takes some discipline and takes some, grit to kind of grind through. But ultimately, we're looking for that personal fit. And I think we've done a pretty good job of that over the years. We've made some bad hires. I mean, everybody has, but we've also made some hires that maybe we didn't think were going to work out so well that have, turned into rock stars. But by using those core values, it's definitely helped us, that along with the vision, because that's something that we share with our team as well. We want them to buy into the vision. And we're also about accountability. So we use an accountability chart. It's different from an organizational chart. We look at the key functions that have to happen for Belrose Storage Group to be successful. And so it's pretty simple. We have acquisitions, right? We have to acquire stuff. And then there's capital servicing. So that's what I'm in charge of. So I'm in charge of the debt and the equity raising. And then our partner, Tim, is in charge of facility operations and Gretchen's in charge of corporate operations. So those are really the key 4 areas in our company. And then we just build out underneath those, the details that need to happen. So like the underwriting and using, Tracked IQ and StoreTrack, is our guy working on our front end and using those tools all the way back through to Kyle and Elena on the accounting, back office, they're handling our investors onboarding and making sure our investors get their distributions and their financial dates and that sort of thing. So we've got it pretty well laid out. Again, it's pretty simple business. It's not super complicated, but I think, to be good at anything, you have to be good at the fundamentals. So we really focus in on the fundamentals, make sure we do a good job on this.
Yeah, that's important to find people who can align with your own values and being held accountable and able to focus on the fundamentals that you have laid out. And talking, we've talked through the entrepreneurship journey, how you went into flipping to notes to self-storage. So of all the investment you've done, what are some of your best investments and what happened during those investments? How did the stars align? And what are some of the worst investments?
Sure. Well, I have to say the distressed mortgage debt business has worked out really well for us. As I mentioned earlier, we've built the company to the point where we're buying directly from the bank, and then we can turn around and chop up that pool of loans that we bought into smaller pools and sell those off at a high markup with virtually no risk. So, I mean, that's a pretty good trade to execute on, and we've been able to do that over and over again. So as much as I love self-storage, the distressed debt business is really what has allowed us to get into self-storage. As far as self-storage goes, we've had some great experiences so far. We've had a couple of exits where our investors have done really well. The one instance, they made 39% annualized return, and another one that made 37% annualized return. So that's that's pretty cool. And it was, just an example of us just having the right team, having the right niche, and just being able to execute our value add strategies that increase the value of the facility over a short period of time. So it was really cool to be able to kind of plan all that out ahead of time, assemble the team and just, go and execute like we had intended and deliver great returns to our investors. And then of course the great thing there is, more often than not, those investors, they come back and want to invest with you again. So we love doing that because we're just excited about helping people grow their wealth through investing in self-storage.
That's awesome. Yeah. I think focusing on one thing at a time right now for self-storage is definitely going to be giving you more growth faster, being that you're focused on one thing. And those returns you mentioned are great. Obviously, it varies based on deal and the market is different, but it's great that you're able to do that for the investors. So for anyone who wants to either achieve the success that you're already having or want to just generate more passive wealth and financial freedom for their family, what are your top 1 or 2 suggestions for them?
I mean, number one is just get started. It pains me when people are just sitting on the sidelines, especially now. If you're sitting with 50 or 100 or $500,000 like in cash on the sidelines, I mean, you're losing buying power every single day. So I just encourage you to, find a sponsor that is trustworthy and experienced and is in an asset class that resonates with you as an investor. You understand what you're getting into. You understand the investment thesis. You understand the risks and the rewards. But I just encourage people to just get started. And then number 2, I would say be patient, especially now. We're in a difficult environment. I think right now, capital preservation is probably a really good outcome for a lot of investments right now. Generating some income is a plus on top of that. And then if you can get some growth as well, I mean, those are the 3 things we look for as investors, right? Security, income, and growth. But I think right now, as an investor myself, I'm emphasizing that capital preservation, that security. So I would just, want folks to be patient and just, ride out, find a good asset class. I'm a fan of self-storage for the environment we're in right now, and just, be patient and ride that out. And then, here probably at another, we're here at the beginning of 2023. I would say, probably the beginning of next year, or maybe even later this year, we're going to see some really incredible buying opportunities. So I would say, be patient, maybe leave a little dry powder on the side, but don't wait too long because of the inflation that I mentioned in point number 1.
Yeah, good point. And because it's hard to really time the market, it's always good to cost dollar average, like what your financial advisor will probably tell you about the stock market. So if the number makes sense, go ahead and invest some and leave some, to continue to cost dollar average. Don't put all your eggs in one basket for sure.
Right.
Well, thank you so much, Tom, for adding value to our listeners and the audience today. If our audience want to get in touch with you or learn more about you, what's the best way for them to do that?
Sure. Thank you so much, Misi. Again, I'm Tom Dunkel, Chief Investment Officer at Belrose Storage Group. You can find us at belrosestorategroup.com. That's Belrose with 1 L. You can also find us on Facebook. We post a lot of my podcast interviews and other value-add articles there. If you go to Facebook and look for the Belrose Storage Group Facebook page, or we're also on LinkedIn. But yeah, I'd love to hear from investors out there that have questions about investing in general or self-storage specifically, and just anything I can do to help.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Missy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.